Hey guys, it's Victoria here. Welcome back to the channel. Hope you guys are doing well. Today I am going to talk about the EMAs. Okay. Real quick disclaimer here before we get started. All right. So remember, please subscribe, like, and comment. Before we get started, guys, let's talk about the market timing really quickly. Remember, you have to be at the charts at the right time. All these times here that are being shared are all based on the Eastern Standard Time. So wherever you are in this world, please adjust your time, your clocks, your mobile phones, and alert yourself to when you need to be in front of these charts, okay? Now, I did talk about this in length in the London pattern video. Now, real quickly, let's do a quick annotation here. Let's do the market cycle. I like to do this all the time because it helps you to understand that this cycle, guys, excuse me, kind of getting over allergies and whatnot, so pardon me. This cycle consists of 3 levels or days, 3 pushes, which are your rise or drops, and definitely 3 ADR. Now, these days could be anywhere from, let's say, it could even be 5 to 10 days that it takes to complete the levels, the pushes, and the 3 ADR. Why? Because you have these levels of consolidation right here. Okay, this is your, would be considered your V1 and V2. This is your A1 and A2. Okay, these levels of consolidation, guys, can last 2 to 3 days. Okay, market can hold these levels for as long as they want to. This is your peak formation low. This is your peak formation high. Okay, and then you'll typically see the 200, the 50, 200 cross around here, and then around here. Okay. Now, also make note, we'll talk about this. Whenever you get to this area, right, with these EMAs, when they cross, right, this is where you want to be flexible, because the market, instead of continuing down, let's say you're expecting it to go down, right, it's going to then reverse. Okay, and then now you're in a bull market and you're continuing on up. Okay, you want to be flexible around here. Okay, and of course here, it can, instead of it going that way, boom, it's going this way. Okay, these multi-session M's and W's, you're going to notice on the chart, these are 1 to 2 days as well. Okay, so our entries are going to be right around here, which is going to be that 5 and 13 cross. Okay, we'll talk about this in length here in just a second. But this is the market maker cycle, your typical cycle. It's never going to be this beautiful because you're going to have, oftentimes, price is going to be rejecting off of the 200s, and it's going to be resetting and continuing this new cycle for the next 3 levels or 3 days or 3 pushes, right? It's going to do that. So just be flexible when that happens. Don't stick like, oh my God, it has to be this way. Because these market makers that go into the office, they're all over the world, right? They have their suits on and you're here in your pajamas, right? You're trying to trade and you're tired. You know what I mean? And they're not. All right, so let me clear this and let's move on. Okay. I have to apologize. My dog might start talking. She's a little loud sometimes. All right, and if she does, I'll just pause this for a little bit so she can get it all out. Okay, so let's talk about exponential moving averages. This is EMAs. Okay, we're going to talk about how you can use them for support and resistance, your entries, take profit, and your stop loss targets. Okay, this is a very, very important part of the strategy. and understanding the movements and placements and the patterns, right? Rejecting off of the EMAs, right? The EMAs give us a true reading of the market direction, market momentum, which is AKA the stop hunts, and again, reliable entry and exit signals for your take profits and stop losses, and know that they're your moving support and resistance. For this strategy, we're going to be using the 5, 13, 50, 200, and 800 EMAs. This is available for free on all your mobile phones for MT4, MT5, and of course, the platforms on your computers, your laptops, your Macs. It's available to you for free that you can plot these on there, okay? The crossovers offer solid trade signals when viewed in the proper context of the market. Now, why am I making sure that you understand what I mean by that? Proper context of the market simply means that you're at the charts at the right time and you're typically taking that second leg M, or perhaps it's a V that you're taking, or an A. It's a V bottom or an A top. Okay, you're also going to see, I'm going to show you examples of how these M and W patterns use the 50 and the 200 as support and resistance, how they reject for them, and then where you're going to be entering. Okay, so again, we have 3 levels of rise and drop. This can happen in 2.5 to 5 days, or it can happen in 10 days. Your first level is your 13 and 50. Your second level is your 50 and 200. Your third level is your 5800, which could be your 200 and 800 as well. You can tell you're in level 3 because these EMAs will be fanned out. And you're also going to notice these, the golden and death crosses, all the EMAs cross at one point and then they are fanned out. It's typically hard to use the EMAs to count your levels at that point. However, I'm going to show you how you can use your 380R. Okay, so what do the EMAs represent? Again, your 5 and 13, your 13 and 50 are your signal lines. I would say your 5 and 13 are more of your sniper entries. Now you can get even sniper than that, and I'll show you what I mean right before that closes, right before the 5 and 13 cross, right? You can go before that. Your 50 EMA is the balance line, your 200 EMA is your home base, and your 800 EMA is your major trend. Remember, price always returns to home. Your most popular EMAs are your 50 and 200. Okay, the 200 EMA shows you the trend. Like if you're looking at the M15, just back up. Excuse me. If you're on the M15, the 200 EMA is showing you the trend from the 1 hour. So the 200 EMA on your 15-minute chart, where is the 50 EMA on the 1 hour time frame. Okay. Why do we use these EMAs? Because they help you to read the price, right? They do. They help you to see where price is rejecting from, getting support or resistance from. And like I shared earlier, your 15-200 crosses are used by most institutions, and they typically represent whether you're in an uptrend or downtrend. And like I said earlier, that 200, 15-200 cross, if prices come to the 200 and they reject, then you know prices are going to go and reset. Okay, they appear in every trading book, and the 5 and 13, they match the TDI signal to give you a responsive signal, basically giving you extra confluence that you're in the right place at the right time. However, none of these indicators can replace your ability to identify the patterns in the count. So that's why I always go over the pattern every time in my videos, because I want you to get that in your head, like this is it right here. This is the pattern. The count will come later. But you'll see here that I'm going to show you how you can use your count in 380Rs. So here's a big picture of GJ. Okay, you can see here, guys, that see how when the 200 and 800 cross, we're in the downtrend. You got the 50 giving us support. Okay, once they start to cross over, we're now in the uptrend. And you can see how the 50 now offers. Did I say that backwards? This is resistance, guys. My bad. 50 gives us resistance when we're going short, and the 50 offers support when we're going long. Okay. Now let's look at the 5 and 13 and the 13 and 50. All right, this is your M15 chart on the Euro USD. And also note that, look at this. stop hunt at the 800 EMA, guys. Look at that. Now, earlier I said you can probably get into this early. When you see that, like here's the Asian box, all right? Your typical stop hunt is 25 to 50 pips above the Asia or 25 to 50 pips below. Now, when this EMA, when you see this here plotted, this will then replace that. This will be your stop hunt right here. So typically, guys, if you're at this particular pair at this time, right before London began, then you could have entered this early, totally, because you can see how prices closed above, closed down, and it rejected. And then you got that pin right here. Your entry could be right at this candle. This would be your entry right before the 5 and 13 actually cross. You could enter here, okay? Or some people would have entered this candle, okay? And you can see here, I love it when you see that price is interacting with yesterday's high and low, because this is your liquidity. This is where the money is at. And another thing, if you can see the pattern here, this is the second leg M. The TDI also draws a pattern nicely for us as well. And as you can see, when this the black line represents the RSI line, which is usually green on most people's charts, but mine is black. Just preference. You can do whatever you want, guys, on colors. But just note that my black line is the green line for the normal TDI. And the red line is your trade signal line. So once that crosses, you can see how it lines up with the 5 and 13 cross. Now with the TDI, I'm not going to spend a lot of time on it, but just know that this 50 is your market baseline. And when the prices cross the 50 market baseline, oh man, you're solid, right? This is, some people usually wait for that to happen before they enter, right? But because this is a second leg, guys, there's no doubt you're entering this thing with your eyes closed. Now your stop loss could be right above here. Okay, now we know this is 25 pips, so it could be right around here. Okay, and your take profit targets could be anywhere. You can be using the previous day low right here is your stop loss. And if you have this drawn on your chart, this is automatically populates it with this indicator, but you can also use this as your stop loss. Okay, so if you miss the 5 and 13 cross, when you see this as a second leg, guys, you can always enter under the 50. Okay, this should be a 13, guys, not a 15. That was my bad. Now we're looking at the same pair, Euro USD, but on a higher time frame, right? And so you always want to get your bias first, right, on the higher time frame. And guys, if you were looking at this on the H1 before you went to the M15, you would have seen that your bias is going to be short for the day, right? Because you have your multi-session M right here. You can see it even in the TDI. You have your two railroad tracks pinning the 200, which I love to see, right? I love to see it when that happens. That's like it's an instant entry. Okay, here's your 5 and 13 cross on the H1. And again, if you miss that entry, you can enter right here, right when prices are underneath the 13 and 50. And then of course you can exit around this area right here using the previous day. Okay. And notice the TDI. You notice how this RSI line came right out of the water, okay? And it just kind of stayed out really quickly. Not really quickly, but it stayed out for a minute there. The moment it starts to cross and go back into the water, guys, you see where that is, where I marked that. I didn't do that, like, I didn't even look at the TDI to use that. I just used yesterday's low. But look, when the moment it starts to cross over, that's your exit too. You can use that as your exit. Now this just represents the same chart, right? Same Euro USD, same H1, but without the candles. So if you have hard time seeing the crosses with the candles on, just change it to a line chart and you can see it really clear. Now for the examples of the W formations off of the 200 and the 50. I had to mention the 50 because whenever we have this, when we see that we're in an uptrend, okay, this is your 1 hour chart, and we see this W right here, and we take the second leg, okay, take that second leg. And if you're here, guys, with this golden, actually, this is the death cross, which I was calling this the train to Bassane. That was my idea of this crazy. When I would see all these EMAs cross like this, right, and there was no way to really count the levels, that's what I would call it, right? And I would expect prices to bounce off of the 50 as opposed of the 200. So you can see it here. And here it looks more like a V. Here more like a, I guess this is like a little funky little W thing here. But here's more like what I was talking about earlier. It could look like a V, and here's again where it can look like a V. Okay. All right, so here's your multi-session W. We're going long, and then just so happens, guys, this is your multi-session M. So that next day, Friday, you're going short. Okay. Now here's your information. Again, this is your H1. This is the euro. This is the USD CAD. You can see here the prices gave us a nice pin, stop hunt, beautiful stop hunt here. So if you were to look at this on a high time frame before you drop down to 15, you know that you're biased. If you came here on Friday and you're like, okay, where am I going today? And you went to H1, you see this huge stop hunt right here on Thursday. And on top of that, it's a multi-session M. You know you're taking this second leg without question. Okay. You see that? Second leg M, and then there's this little mini M here, which I consider this like an anchor point right here, right? Because you see this little M that was built here within the bigger M, right? And this is where you enter. You could have entered this one pretty early too, right? With this candle right here. And then of course you could have taken, you could have had 2 exit points. You could have exited at the 50. And then you could add another exit here at the previous day's low. Okay. And earlier when I mentioned, you can also gauge, this is your Asia high, Asia low of the previous day. You can also use that, right? Just like it is here, you can use those as your and exits, because sometimes the Asia low, like for right here, gets extended. Right, and that's why this then draws here. But if for whatever reason it does get extended, you can also use that. You can use this as your exit. Okay, and here's another example, guys. We're still going short. You see, you gave us two pins. You got your pin here, and you got your pin there. 2 railroad tracks. We're taking this long short. Okay. Here we go again. Look what happened. This is beautiful, right? We thought prices were going to continue to go on up, but we had to be flexible. When prices get here at this 200, guys, you got to be flexible. Look, what did it do? It rejected off of the 200 and gave us 2 pins, first leg, second leg. And this one's not quite a railroad, but this is one of those spindle top hammer, inverted hammer type things where you could have taken this entry right here. Okay, and went short. All right, here's an example of the golden cross. Now, usually you can't use the EMAs to identify what level you're in because they're already spread out. Some people like to use the Asian boxes. As you can see, they'll use the Asia stacking. I don't use those, guys. I don't really like to. For me, it's just easier to use 3 ADR. So remember, the indicator that is available for free will tell you the average daily range for the pair. And we're looking at the Aussie dollar. The average range is 69 pips. So I drew this in here with the rectangle indicator, or whatever you want to call it. I drew 3 boxes that were 69 pips each, and I just stacked them, right? And then I added these little lines here. So that's my 3 ADR. That's how I'm going to know when this thing is about to reverse, right? And look, right about 2.5 ADR, right? Because this is 1, 2, and it didn't go all the way down, right? It gave us about halfway through. That's whenever it gave us our multi-session W to go back up, okay? But again, it didn't even really finish, right? It didn't finish going all the way up because we got some rejection, and then it came back, and now we're going back short. So always be mindful of the 200. Here's the example of the death cross. My train did the same, going up with no way of using the EMAs. You can again plot your 3 ADRs here. Here's another example of where we did not get 3 complete ADRs. We got like, let's say 1.5. Here's 1, and then just right here in the middle, like 1.5. And if you watch my previous video on resets, what do we know about 1 and 1.5 ADR, right? That means that that thing is going to reset. So this bull market, look guys, and this is why we have to use a 3 ADR and not necessarily 3 days of rise, because look how long it took. Okay, look how long it took. Let's see. Let's not count that, it'll be 0. So 1, 2, 3, 4, 5 days, okay, before this thing, we got our 1.5 ADR after 5 days. Excuse me, okay? So after 5 days, guys, we got it. And then this thing started to reverse. Look at that, multi-session M, took the second leg, and we went down. And this thing continued to drop, by the way, because as you can see here, the 50 and the 200 are crossing. And once that crosses, it's game over, okay? So keep in mind of why this 3 ADR is so important. All the indicators I use do all this stuff for me automatically, but you can do this manually, okay? Now here's an example where I count the levels with pushes, because sometimes you can count the levels with consolidation. I don't really care to do that anymore. I like to just count it with a push. So I'm like, okay, push, consolidate, push, consolidate, push. So it gave me my 3 pushes up. I didn't put the boxes here. So in my next slide, you're going to see the 3 ADR, but this is another way you can count your levels with the pushes. Okay, and again, this is when it's not super clear with the EMAs, right? Okay. Here's another example when it's not super clear with the EMAs, but you have your 3 pushes and then you had your 3 ADR. So right around the 2.5 ADRs when this thing gave us our multi-session, okay, and then we took that next one down. Now remember, be mindful when prices get here to see what happens. All right, so now we have, this is UJ. A lot of people love this pair. This one is a super duper clear count using the levels, you know, using the EMAs to count our levels, okay? So we have level 1, 1350, level 2, 5200, level 3. We have the 50 and 800 cross, or you may see the 200, 800 cross. So we have our M, W. All right, and then here is all of them together. We got our EMAs, we got our, that represent our 3 levels, our 3 pushes, and our 3 ADR, right? We have the 3 ADR drawn from up here, from the multi-session. Okay, this particular pair has 72. This is EJ still, 72 pips average daily, so each one of these boxes are 72. And identify the pushes. Okay, and I started to count the pushes after the cross of the level 1 cross, the 13 and 50. That's where I start that count. I believe this, the reason why I don't count this one, because it completed that previous cycle here. Okay, you can see your M all the way to your W. All right, so now it's time for you to go do your homework. I want you to go find your favorite pairs. I want you to mark your peak formation highs and lows. You can identify those with head and shoulder patterns or your multi-session M's or W's. I want you to plot your 3 ADR using the rectangle, you know, I don't know what else to call it, but an indicator or your drawing tool that's available to you all. Use that to plot it. Do it manually. Okay, and remember, when price rejects off the 200 TMA, be flexible. Be flexible, because prices, if it doesn't cross, the 50 and 200 do not cross, then that means it's going to reject and give you a W, but you're going to take that second leg, or it's going to pin and give you 2 railroad tracks, or it's going to give you that inverted hammer, and you're going to take that thing short. Okay, What all this means simply is that on the higher time frame H4, it's pulling back so that it can complete that cycle on the H4 as well. All right. So remember, your entries can be identified by the 5 and 13 cross, which typically lines up with that TDI cross, the green and the red trade signal line, the RSI cross right there. And these are usually at your highs and lows of the day. Okay. And if you have a multi-session M or W, then your chances are you can take the second entry of the 13 and 50 cross. Remember, your exits can be, you can identify your exits with your yesterday's high or low, or yesterday's Asia's high or low, or whatever pin from the previous day. You can use that. And remember, risk management is very important. You want to average around 20 pips stop loss. Don't risk more than you can stomach. And again, there's plenty of free risk management calculators online, guys. Don't take my word for it. Don't take none of this as my word. I want you to go and see it for yourself. Do the homework for yourself, okay? And with that, guys, I hope you found value in this training. Don't forget to like, subscribe, comment on my channel, and we will see you on the next one. Thank you.